Okay, now this is kind of an important topic from exam point of view, national income statistic. Then after linked to that topic is growth and development, which we'll talk about in today's class. So first thing that you need to understand is that what's national income, why is that important, excuse me, and why all these countries record and calculate their national income statistics, right? Now first things first, you need to know what national income is. National income is the total income of all the people who are living in a country, right? That sounds very obvious. National income within the borders of that country, whoever is living, you add up their income, and that is what should be your national income, and that is correct, right? Now the first measure of national income is GDP, right? Now why am I saying that this is the first statistic? So there are four national income measures or four statistics of national income that we will study as part of our syllabus. So the first one being gross domestic product, GDP, right? Income of all people who are living in a country. So what is GDP? GDP stands for gross domestic product, and it is the total value, right, of all goods and services produced in an economy during certain time period. If the income of all people living within the borders of that country, if the income of all people living within the borders of that country are added, um, is added, uh, it is, sorry, my bad. It is the income of all the people who are living within the borders of that country, uh, whether they are that country nationals or not. Okay, now the first thing that we need to understand, right? Now we are saying two things over here. What is national income? Income of all people who are living in a country. But then at the same time, I said that it is the value of all goods and services produced in a country. Now, this might sound a little tricky, and this might sound, that we are saying two different things, and then we are appearing them, making them appear as the same. So, what's going on exactly here? Okay, think about this. First things first. So, if whatever revenue Mega Lecture earns, let's talk about this, right? Whatever income Mega Lecture earns, that's Mega Lecture's revenue, right? So, the income that Mega Lecture earns is our revenue. Now let's talk about this. Revenue of Mega Lecture is total receipt of cash money, sale of its online classes. Okay, this is the only source of revenue Mega Lecture has, right? So how is Mega Lecture earning revenue? From the sale of its live classes, right? So it's an online teaching platform. We arrange teachers. There are students who want to study. Students pay us the subscription, monthly subscription, whatever it is. And that is how, if we add up the income of all, if we add up the cash amount paid by all the students to us during certain month, during certain year, that will be our revenue, right? Easy, simple, obvious. Okay. Now, this is the revenue that we earn, which students pay to us for our service of online teaching. Great, good enough. Okay, now let's talk about this. Does Mega Lecture get to keep all this cash? Does Mega Lecture get to keep all this amount? What do you think, Amna? So whatever revenue we earn, the cash that students pay us, it's the total receipt of cash and money from the sale of its online classes that our students pay us. Now, my question to you is, do we get to keep all this amount, all this cash, or yes or no? And
No,
why? No, exactly. Why not?
because you have to pay the employees and
Exactly.
variable costs
Excellent.
and the tax.
Excellent. That's correct, right? So this is not what this company can keep, right? This entire amount cannot be kept by Mega Lecture. Why? Because obviously, to provide these services, we have to engage some resources, and those resources are not for free, but we have to pay them, right? So from this revenue, Mega Lecture has to pay its teacher, their salaries, um, right? Pay other expenses, like you said, fixed cost, uh, rent, electricity, right? Now think about this. And but before that, okay, so these are our expenses which have to pay. Why? Because we are engaging some resources. So with whichever place we have our office in, obviously that's not a free space. Either we have bought it, like usually the chances are less. Why? Because it's easier for businesses to rent out premises, right? So we have rented out that premise and we have to pay rent for that. There's electricity expense that we have to pay, other utilities, gas, blah, 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 right? And obviously the teachers that are paying, they have to be paid salaries, and the other staff members have to be paid salaries and all that. After paying all the expenses, the money that we are left is known as profit. Yes, that is the amount that the mega lecture owner gets to keep. Yes or no, right? The remaining amount after paying our expenses is known as our profit. Easy, we good on this? Okay. Which is basically business owners' income from running and managing this business, right? Are we good on this, right? The idea is fairly simple, that when you subtract your expenses from your revenue, the amount that you are left with is your profit, and this profit belongs to company owners or business owners, and it is their return for running that business. We good on this? Okay. Now think about this. Now this is very interesting point, and I'm about to explain you. The revenue that a business earned, the value of goods and services that it sold, is technically the income of all the people or entities that are involved in providing that product. I repeat, the value of the good or the service that a business produces is equivalent to the income of all the people and entities who are involved in providing that service. How so? Let's have a look at. So the revenue that we earn is the value of our online teaching. Do you agree? The revenue that we generate is the value. So let's say we generate 1 million rupees. So 10 lakh worth of classes we provide every month. That's the value of our services that we are providing to our students every month, right? Now, this is becoming income for whom? Teachers. From this 1 lakh, from this 10 lakh rupees, we have to pay our teachers' salaries. From this 10 lakh rupees, we have to pay our rent, our electricity, and all these. And whatever, so salaries become income for teachers. Fixed cost. So if you think of rent, rent is becoming income for whom? Whoever owns that property where our office is located. Yes or no? So rent becomes income of landlord, that property owners. Electricity becomes income of the electricity providing company, Babda, in case of Pakistan, right, which provides electricity in Pakistan, and so on and so forth, right? If we buy some resources, like we buy furniture, furniture becomes income for the furniture producing company, and so on. And whatever amount is left, that's called profit, and that is the income of the business owners. Are you getting me? So technically, from now onwards, when I say that GDP is the total value of all goods and services produced in a country, and GDP is the income of all the people who are living in a country, can you understand that the two things are exactly the same? Right? Now, first tell me if you got this point or not. I repeat this thing. GDP is the total value of all goods and services produced in a country, and GDP is the total income of all people who are living in a country. Do these two statements still look different to you, or now can you understand that the two statements are the same? Yeah.
So GNP and GDP?
No. GNP is another form of GDP. We are coming to that. Right now, we have just discussed GDP, gross domestic product. So what I'm saying is that on some places, I might be using this definition of GDP as the total value of goods and services produced in a country. And if I say that GDP is the total income of all the people who are living in a country, so the two statements are the same. There's absolutely no difference. That's what I'm saying. Because we have just seen that the worth of services or the value of products that you produce is becoming the income of all the people or the entities that are involved with that business. Are you getting me? So similarly, let's take another example, and this will help you better understand the idea. Okay. The revenue that McDonald's generate, McDonald's is a big fast food chain, global chain, in fact, right? So let's say one restaurant, let's think of a very simple example. So let's say there's one branch or one restaurant of McDonald's in Lahore, Karachi, wherever. Whatever revenue it generate, that is the sale of its products. How much worth of burgers did it sell, how much worth of fries did it sell, how much worth of coke it's sold, right? All these things. So let's say in one period they sold goods worth 20 lakh rupees, right? In 1 month, one branch of McDonald's sold goods worth 20 lakh rupees. Is this simple? Should be easy, right? Now, from this 20
Yes.
lakh, yeah, from this 20 lakh rupees, right, McDonald's has to pay its expenses, just like any other business would do, right? They have to pay the rent where they are located. That becomes income for landlord, right? Uh, right, because that person owns that space, area, whatever, right, where this restaurant is located, right? Income for landlord. Then similarly, um, they're paying their electricity charges, right? That is becoming income for whom? Income for electricity producing, right? We good on this? Okay, that's income for electricity producing company. Then they have to pay for salaries, the staff that is working there, whether that person is, whether those people are working in their kitchen or as their riders who deliver food to customers home, or they're working at the front desk taking the order, right? Whatever role they have in the restaurant, right? But obviously they will be earning some income or salary or wages, right? Income for workers, right? And so on and so forth, right? And whatever is left at the end after paying all their expenses is the profit. That profit is becoming income for whom? That profit is income for business owners. So in a way, the value of goods, the worth of goods that McDonald's sold during certain time period was equal to the income of all the people or entities that are involved with that business. Is this making sense?
Yes.
Great, perfect, right? Now we will be using two definitions for GDP, right? GDP is the total value of all goods and services produced in a country during certain time period. And GDP is income of all the people who are living in a country, right? So please never be confused, get confused by that, how the two statements are the same. We have just discussed that two things are exactly the same. Total value of all goods and services produced in a country during certain time period, or total income of all the people who are living in a country. That is what GDP is. Now we are coming to the second part, which is GNP, gross national product, right? So we are recapping what we did yesterday and then move forward from there. Now, gross national product is the income of a certain country nationals, regardless of their place of residence. It's the income of a certain country nationals, regardless of their place of residence. Now, think about this. Do you think that in Pakistan or in any other country, there will be some non-nationals living at any point? So let's say at this point in time, do you expect in Pakistan to have some non-nationals who are not Pakistani nationals, who are foreigners, Americans, Chinese, I don't know, some other country nationalities, right? And the answer to that is yes, right? I mean, nowadays world is a global village. People work in other countries where they don't belong, but this is how it works, right? So everyone's income who's living in Pakistan, whether they are Pakistani nationals or not, is part of what? It's part of GDP. Are you guys following me, right? But in gross national product, you want to calculate the income of only Pakistani nationals, whether they are in Pakistan or they are outside Pakistan. Simple. If you understand this, it will be simple and easy. Domestic product meaning what is domestically produced within the borders. National product means income of only our country nationals, regardless of their place in the world, whether they are in Pakistan or abroad. So, I mean, a simple example that I give is that every family, more or less, has some family members who are living abroad, working abroad, but they're still Pakistani nationals, right? So they don't have nationality of that country. So whatever income they earn there, whatever income my family members are earning in UK or let's say Dubai or some other country, I don't know, where they own a business. They might own a business over there, or they might be working there as an employment, like a job, whatever job they have, right? So their income will be part of GNP, but their income will not be part of Pakistan's GDP. How much is this making sense so far? Is this making sense? Now, the next question, if this part is clear, if not, please ask me. Please ask me, because we are building everything on the previous thing, right? Right, great. Now, the next thing is how to calculate GNP from GDP. Have a look at this. Now, gross national product is equals to GDP plus net income from abroad. Now, this word, I don't want you to be scared from this word. This is a very simple thing that we have just discussed. So net income from abroad is, as I was telling you, you add the income of Pakistani nationals living abroad to your GDP, because I said they're Pakistani nationals, their income should be included, but you subtract the income of non-nationals who are living in your country, income earned by foreigners living in your country. So from the GDP to calculate GNP. So if we have to calculate GNP from the GDP, what will we do? We'll add the income of Pakistani nationals who are working in other countries. That's the first part. And in the second part, you'll subtract the income of non-Pakistanis who are living, working, and earning in Pakistan. Simple. So when you do this, so you convert the GDP into GNP. Simple and easy. Any confusion so far? Anything that's not clear? Students, right? Do let me know if there is any confusion so far, right? Amna, is this clear? Right? So GDP, income of all people living in that country, whether they are Pakistani nationals or not. That's something that you need to know, whether they are that country nationals or not, whereas GNP is the income of only that country nationals, regardless of their place of residence. Regardless of their place of residence. Okay. Now, after the gross measures, you have to calculate the net measures. Then there was GDP, gross domestic product, and now NDP is net domestic product. So it's very simple. Don't be afraid of this. This only means that from the gross measure, you subtract depreciation. So from the gross measure, when you subtract depreciation, you get net measure. Are you following? Okay, now think about this. So why are we subtracting depreciation? And the first thing you might be asking yourself, if you haven't come across this word before, is what's depreciation? So depreciation is the wear and tear of assets. So when you buy a new phone, right, it has a certain value. You keep using it 1 year, 2 year, 3 year, it's not the same value. The processor might have become slower, the screen might have some scratches, the body of the phone might have some scratches, and so on and so forth, right? The performance and the appearance is not the same as it was when you bought it, right? Now, therefore, its value will be less in the market compared to what it was before. And this applies to every asset in the world, whether that be a car, whether that be a house, whether that be, furniture, anything, right? When you buy something new, it's better quality, it has better performance, it's more valuable. With usage over time, its value deteriorates, decreases, right? Okay. Now, why are we subtracting depreciation? Because think about this, when a country produces something over a period, it makes use of assets. I mean, you are constantly using assets to produce something. We at Mega Lecture, we are using laptops, we are using, furniture in our office. It's a online thing, so we don't have other assets. But if you think of conventional business, there will be production plant that they're using. They have a building where their office is located that is being depreciated, and their other assets and so on. Their transport vehicles or whatever. I mean, that's about it. Okay. Now we subtract depreciation from gross measures to get a better idea of the net value that you generated in that period. Right. So yesterday I gave a good example, I guess, to Mubin, and that was like, think about this. If I offer you a job, right? If I offer you a job opportunity, let's say, and that pays you 50,000 rupees. Okay, sounds good, fair enough. But to come to the office, like to travel daily between office and home, let's say you are spending 10,000 rupees. right? You're spending 10,000 rupees just to go there and to work, right? So technically your net benefit from that job, so your gross benefit is 50,000. If anyone says how much is salary or how much you earn, you'll say 50,000, but technically you're spending 10,000 rupees there. So the net gain that you get is 40,000. Similarly, if you have another job offer that pays you 45,000 rupees, and the transport it takes you, it's really close to your home, let's say, and the only cost it takes you to travel is only 3,000. Now 45 minus 3 is 42. So technically this second job offer is saving you 42,000, whereas the first job is saving you 40,000. So even though the first job is paying you more, but in net terms, which one is better? The second one. So that's the point. That's the difference between gross measure and net measures. Gross measure, how much value of goods you produce. But in producing those value of goods, in producing those goods, how much value you destroyed, how much value you destroyed, because at the end of the day, those assets that you used will be useless and you will need to replace those with newer assets. Are you getting what I'm trying to say, right? So you'll need to replace those with newer assets. So coming back to the point, net domestic product is basically gross domestic product minus depreciation. So net domestic product is a better measure of national income as it accounts for the lost value of assets, which is basically the amount businesses would be spending to replace those assets in the future. Right? So it's only as simple as that. So from GDP, subtract depreciation, you get the net domestic product, and from GNP, gross national product, that we just discussed above, you subtract depreciation, you get net national product. So economists decide, right? So I mean, later on, if you get the chance to study economics at later or higher levels, you'll get to see that economists use different values for different purposes, right? So depending upon the need of the thing, they might be using gross measure or net measure. But yesterday, Mubin asked a very relevant question. He said, gross domestic product is the basis for calculating other statistic. And the answer to that is yes, right? That is why GDP, gross domestic product, is the most commonly used method, and that's the most commonly used statistic, right? I mean, it's not that others are not there. They are also estimating certain thing. So the idea is fairly simple. If you have to compare Pakistan's performance with, let's say, Mexico's performance or any other country in the world, right? So we compare Pakistan's GDP with Mexico's GDP. If we have to compare a net measure, so then we do net domestic product of Pakistan compared to net domestic product of Mexico, right? Whichever statistic we are doing, obviously that would be same for the two countries to allow for comparison. Otherwise, we can't do that, right? So coming back to the point, but GDP is the most commonly used statistic. Okay, now comes in the second thing. Quickly, how is GDP determined? The idea is fairly simple. How is GDP determined? Now, GDP is determined where the aggregate demand of a country is equal to its aggregate supply. What is aggregate demand? What is the total demand for goods and services, right? How many goods and services consumers are demanding in that country, and what is aggregate supply? Aggregate supply is the total production of goods and services in that country. What is the total output of goods that's being produced in that country, right? So where the aggregate demand, aggregate supply intersect, that is your GDP value. Okay, fair enough, good enough. Okay, that was a theoretical approach to it. That's obviously a theoretical approach to it. But how do you calculate or estimate, right? How do you calculate or estimate the value of GDP in a country? That's a real life thing, right? That's a practical usage. So we are coming to now that thing. Okay, now there are three ways to calculate GDP, students, quickly. Now there's income approach, there is expenditure approach, and there is product approach. So these are the three methods that countries use in real life to calculate GDP. Okay, now income approach, as the word suggests, you just add up the income of all the people who are living in a country. Now, still, there's a question there. How the government gets to find how much income is Qasim Shamim earning? How much is income XYZD person in Pakistan is earning? The answer is fairly simple. When people have to file their tax returns, have a look at this. It is summation of income of all individuals who are living in a country during certain time period, which is basically estimated through tax returns. Now, I need to file a document to the government, and if I don't, I will tell you what are the consequences to tell government how much income I earned. So I get a letter from Mega Lecture mentioning how much income Qasim earned during that time period, which is an official document. If Mega Lecture says something incorrectly, then Mega Lecture is accountable to law and so on. Then with that document, I file my tax return telling government how much I earned, and against that income, I have to pay my income tax. That's how it works in every country of the world. Simple, easy. Okay. How do businesses have to show their income? Businesses have to also file tax returns, right? So businesses, Mega Lecture is also filing tax return every year, telling the government how much we earn from the sale of our online classes. If you think of another business, I don't know, another business manufactures clothes in Pakistan, Gohar Textile Mill manufacturing clothes, they have to tell the government this much value of goods we produce, this much profit we made, and this is, then the government will tell them how much tax they have to pay, which they will pay. Okay, easy, simple, no worries. But there's a small problem. People understate their income to avoid taxes, and therefore, this method of GDP will always understate value when people and businesses prefer to understate incomes to avoid taxes. How many of you are following me over here, right? So to avoid taxes, individuals and businesses understate their income, and that is what makes excuse me, and that is what understates your GDP when you calculate GDP using the income approach. Any confusion so far, students? Right? This is making sense. I mean, there is a whole another debate. If you ask me that, how do people get away with it? I mean, there are a lot of ways about it, right? But let's have that discussion for some other day, right? Then another way, Amna, are you following? Do let me know, right? Another method to calculate GDP is to use expenditure approach. Now, what is expenditure approach? You just add up the income. It is summation of all people's expenditure on all goods and services during certain time period. Whatever income I earn, I go to petrol station, I get my tank full, right? I go to departmental store, I buy groceries for my home. I pay my electricity charges, I pay my rent charges, and so on and so forth, right? So all of these expenditures that I'm making will be recorded with the companies or the businesses with which I'm buying the products. Again, I told you, right? These businesses have to declare to the government how much sale they make. Just like, think about this, your parents are, simple example, your parents are paying us for your online classes at Mega Lecture, right? Now, when they make a payment through the bank account, or I mean, cash is a little outdated process, even if you pay cash, right? Now, we, like Mega Lecture, has to tell the government how much revenue we earned, right? If we, not disclose it properly, if we incorrectly tell the government, right, then that would be subject to legal action, which you don't want, right? Okay. So coming back to the point, so that is when government add up the expenditure of all people on all goods and services, food, clothes, laptops, shoes, cars, bags, cosmetics, I don't know, everything that you can imagine. So that gives you the GDP value through the expenditure approach. Now, here's the thing. Expenditure approach is a better approach for calculating GDP, since it is easier for people to understand their income, but it is difficult for them to hide their expenditure. I mean, expenditure could also be hidden, but I mean, it's relatively hard, or relatively more difficult to not disclose your expenditure, right? Because when you're making a transaction with another company or entity, that would be disclosed, that would become on the, that would be recorded somewhere, which the government can then check. Easy, right? So expenditure approach doesn't understate GDP as much as the income approach does. Okay. Now comes in the third and the last type of calculating GDP, which is the product approach. Now, what does product approach do? Now, let's first have a look at this. So there is this thing, this concept known as value added. What's value added? Selling price of final good minus cost of components. Okay. Let's think of a simple example. Let's say a t-shirt, a men t-shirt, is it takes 5 kg of cotton. So this example I gave yesterday. So one t-shirt is taking 5 kg of cotton to be produced, right? Okay, great, fair enough. Now this 5 kg of cotton might be worth, let's say, 1,000 rupees in total, right, in the market. So 5 kg of cotton is worth 1,000 rupees in Pakistan, and that is the major cost of component. But obviously there might be some other components involved. So when you make a t-shirt out of cotton, you might be dyeing, you might be using some dyes on the product, and that will have some cost. You might be using some stitches, so that thread that you're using, blah blah blah, whatever, right? So if you add up the cost of all these things, that will give you the cost of components. Now whenever a company manufactures a product, do you think that the company is selling it at the same price as much it costs them to produce it, right? And the answer is no, right? Why would they do that? Because then they make no profit out of it, right? So the price of the good at which they sell it for is higher than the cost. It's higher than the cost they spend, higher than the cost that they spend in manufacturing that product, right? Easy, fair enough. So that component is known as value added. So it's slightly different from profit, right? Because a lot of students get confused and they say, then how is that different? Because profit is revenue minus cost or sales minus cost. The only difference between value added and profit is that it only says cost of components. It doesn't subtract other things like fixed cost, rent, electricity expense and all that. Mubin, Amna, are you guys following? Right, Mubin? So
Yes, sir.
great, perfect. So cost of components is just the tangible goods. You can think about this. Cost of components is just the tangible goods that went into producing that product, as simple, right? So if you think of a laptop, what the plastic that was being used, the microprocessors, the other technical, electronic components being used. So that's cost of components. You don't subtract rent and other things, right? Okay, so when you subtract that, so let's say the components of a laptop costed you 30,000 rupees to buy, and the final laptop is being sold for 50,000. So 50 minus 30 gives you 20,000. That's value added. Now, how do you calculate GDP from this? It calculates GDP through a value added approach, which is basically the difference between selling price and cost of components. If value added is added, if value added is added for all value added is added for all the products produced in a country, that would estimate the country's GDP using the product approach. That's the idea, right? Now you might be thinking another thing. Let me quickly answer that and we'll move forward. Now, the three approaches to income should be giving you, the three approaches to calculating GDP, the three methods that we have just discussed, should give you the same value of GDP, but that does not happen. Why? Let me tell you, right? So income is basically equal to my expenditure, right? So the income that I, earn would be, but there's a small problem, right? So there's a small problem here, right? So the income that I earn in this period, I might not spend all of it. I might save it and spend it in the later periods. Is this making sense? So the first problem with, calculating GDP using the income and the expenditure approach and expecting the two answers to be the same is the one that I just explained you, right? That people might earn income in this period and might spend in a later period, right? And secondly, another reason why the two might not be equal is what I already told you, that people understate their income to avoid taxes. Expenditure doesn't go unnoticed, but income can go unnoticed or undeclared. Therefore, income approach would be usually lower than the amount that you get, right? So let's say declared income of Pakistani citizens might be $3 billion in 1 year, and the expenditure might show that it was 3.5 billion. So that extra 5 billion, that extra 0.5 billion is the undeclared income that people didn't mention. Is this making sense, students? Is making sense? Okay, so that's the idea. But ideally, as per the theory, if no transaction is undeclared, then all the three approaches to GDP should give you the same value. Easy, we good? Any confusion so far? Okay, now students, if this is clear, then we are moving forward, and this is a very, very important topic from exam point of view. The one that we just discussed, I mean, that is also important, but perhaps not as much as the one that we're about to discuss, right? So that is, right? Right. Okay. That is GDP a good indicator of development? Now, the first thing that you need to understand, what is development? And you will see often in the past paper questions, the wording is often very similar, right? Is GDP a good indicator of development? Or something like, should countries use GDP to gauge development? Or what are good indicators of development, right? So these are some of the possible wordings that you will see once we come to past papers that examiners use. So the first thing I was discussing with Mubin yesterday, that what's development, right? It might be a new word for you, I mean, right? But otherwise, obviously, it's not an unknown word to you. You must have heard development all the time. So development is basically the living standards of a country nationals. How high or how low are the living standards? Now that is what that is what the country's development is basically. Now, what includes living standards, or what affects living standards? That's the question that we wanted to discuss. What affects living standards? Anything. Yes, that's correct. Very good. Let me write this down. Countries living standards. Okay, now students, think about this. The most important one, as you very rightly said, Amna, right? It's the income, right? But here's the thing, right? So what is development? It's living standards. The next question we are discovering here is that what affects these living standards, right? So technically, anything under the sky that affects the quality of life, that could be as small as a technology, improvement in technology from 4G to 5G, 5G to, I don't know, 6G, whatever, right? From cable television to satellite television, right? Any small thing you can think of, but something as big as you mentioned, income, because that determines how much can you afford. Are you getting me or not, right? So technically, anything under the sky that affects the quality of life in a certain country will affect that country's living standards, ranging from, right? Because think about this: when technology improves, to um, right, to increase in with which goods and services, right? This is making sense, right? So it is basically anything that affects the quality of life, something as small as improvement technology to something as big as income. Okay, economic growth is yes, absolutely, that's where I'm coming to. Very good, movie. That's a good point. Exactly, economic growth is different from development, right? And just to put it there, now think about it. This is very important, right? Now students, think about this. Development is a step forward in the progress. I repeat, development is a step forward. The first thing that you need is growth, because what is growth? I'll tell you in a bit. Growth is basically about increase in income. Increase in income. Economic growth. What is economic growth? Let's quickly talk about that, because then that might uh, economic growth is the percentage increase in country's GDP from one period. Now, students, listen to me very carefully, right? Economic growth is the percentage increase in a country's GDP from one period to another. Okay, think about this. So let's say there are two countries that are earning exactly the same GDP, Pakistan and Malaysia, let's say. Pakistan has GDP worth $3 billion. Malaysia has GDP worth $3 billion. Are we exactly at the same point? Yes or no? For the sake of simplicity, let's put it down like this, and that's not a very realistic assumption, but let's assume Pakistan and Malaysia has same, by the way, very close. Indonesia would be a good example because Indonesia has fourth most populous, fourth, yeah, no, sorry, my bad. But Indonesia's and Pakistan's population might also be close. I'm not sure, right? So don't quote me anyway, right? But let's assume we are taking the example of Indonesia. I mean, it's a hypothetical example, it doesn't matter. Indonesia's GDP is $3 billion, Pakistan's GDP is $3 billion. Easy. So the total income or the total value of all goods and services produced in Indonesia and Pakistan is the same. Okay, amazing, sounds good. Let's assume another assumption that the total population is also same. Pakistan has 220 million people. Indonesia also has 220 million people. Easy, good, sounds enough. Okay. Now, if in the next period, like this was the scenario of 2021, if in 2022, Indonesia grew by 10%. Now, students, listen to me very carefully. If Indonesia's GDP in this period grows by 10%, in 2022, it grows by 10%. So what will that be? 10% higher of 3 billion. 10% higher of 3 billion is their new GDP. And if Pakistan only grew by 5%, so next period, which country would have higher GDP? Right? Indonesia is growing by 10%, grew by 10%. Their GDP increased by 10%. Pakistan GDP in that period increased by 5%. So in that next period, obviously Indonesia's GDP would be higher than Pakistan. Population has stayed the same. Growth has taken place in both the countries, but Indonesia had more, Pakistan had less. So next year, Pakistani citizen would be relatively poorer. Next year, Pakistani citizen would technically be poorer than the Indonesian citizen. Do you agree with me? It's as simple as that, right? So that's what I meant, that economic growth is basically the income. Economic growth is the percentage increase in a country's GDP from one period to another. Okay, now students, the class is ending. I can continue this for 10 more minutes if that sounds good to you, right? So we'll quickly wrap this up. If this sounds like a plan, then I'll end the class and we'll join the class with the same link. So what do you suggest? So let's understand this thing part here and then tomorrow we can. Okay, so I'm ending it, rejoin.